remember I cried. My dad told me, what are you going to do when you don't know math? I cried.
Guys, we're saying that, okay, let me remove this. We're saying that if you want to capture a quality purchase, you go to vendor, then enter bill. Okay. But if you return goods to the supplier, the bill is supposed to reduce. And because of that, you're saying you come to still vendor, then you say receive items and enter bill. When you click on it, there'll be two options here. There'll be a bill and a credit. You click on credit, okay? And then you get the supplier to return the goods. We only had one supplier, with Giotto. So you click on it, and then you capture the item. Of course, you have expenses and item, but we are interested in items. What item did Giotto sell to you? Now let's just, I need to confirm that. You don't want to put the wrong figure. Giotto sold to us what? So, purchase. Giotto had sold to us Y16 and Y8. Okay. So if I go to item, I'll put Y16, okay, Y10 probably. Okay. Then you put quantity that you're returning. Assuming I'm returning, seeing the amount is demanding us, it's 178. But should I return anything? This bill must reduce. Okay, so assuming I return 10 units only. Now what will happen is, when I click on description, say purchase return, I've returned the goods to the supplier. So the amount is 81. When I press save and close, say yes, you want to close, yes. Okay, so that's because if you go to vendor again and see how much this guy demands us, because at the end of the day, you want to be sure that if you return the goods, the balance should reduce. Okay, so when you check this guy, now the balance, you see, last time it was 178. Yeah, because we return some goods, that reduce automatically to 170 now. Okay, guys, that is how we do returns. So let's look at end of year adjustments. Someone shared a few questions. I can share those with you. You have these written ones. So this, let me just share what I have. Okay. So for returns, I mean for end of year adjustments, they will tell you that in this case, for example, our year was ending 30th June 2022. I will tell you that maybe 1st July 2022. Okay, that is after the year end. I'll tell you that depreciation is charged at 10%, straight line balance, and blah blah. So guys, we know how to apply those percentages. Straight line, you just get 10% of the cost of the motor vehicle. Okay. Here's nothing to think about. You have the question sheet. So get the 10% and multiply it by the cost of the item that is there. If you're saying the motor vehicle is depreciated straight line, 10%, look at the cost of the motor vehicle. Okay. If it is 10M, 10% of 10M is 1M. That is the depreciation. Okay. For this one, you don't compute them from the QuickBooks like you guys are thinking. You get the figures aside, then you input them. So how we input them is you use journals. End of year adjustments, all of them are treated using general journal. So you come to accountant and make general journals. Okay, all end of year adjustments are treated from this side. Maybe except inventory, closing inventory, which you normally adjust using the inventory adjustment, as we shall say. So depreciation is an expense, assuming you got 1M. So you're supposed to debit, therefore, depreciation, and you credit accumulated depreciation. Okay. Depreciation is an income statement item, it's an expense. Whereas accumulated depreciation is a balance sheet item. So if I may debit the expense first, you come here under account, put the date, usually it's the close of the year, 30th June. Okay, 2022, not 2021. Okay, close of the year. Then you put account for depreciation. So usually they're not there, you're supposed to add them yourself. So you add, it's an expense account, say continue, and you name it depreciation. Okay. If you want to be specific with which asset you're depreciating, you can say motor vehicle depreciation. It is really upon you. Vehicle. Motor vehicle depreciation. Okay, that's an expense account. Eh? Then you say okay. Okay, so when you save and okay, the figure you computed from aside is what you bring here. You said 1M. Okay, then you credit accumulated depreciation. So still the same thing. Come here and add. But I said this one is a balance sheet what? Item. So you count fixed assets. And you say continue. So then you say yeah, motor vehicle. Okay, motor vehicle. Then you emphasize that this is accumulated what? Depreciation. Then you say save. Okay, so you have those two accounts. So when you save and close, and you got your charts of accounts. So accounts and accountant, charts of accounts. And you say maximize. And maximize, when you come under your expenses, let's begin with assets. When you come under your assets, you find that they have motor vehicle accumulated depreciation account. Okay, and it's a negative, that's why, because it's a credit under assets. Then when you look for under expenses and you look for depreciation of the motor vehicle, you will still see it there. Here, motor vehicle depreciation. When you want to be sure you click on it, the amount will be there 1M. So guys, that's how we deal with depreciation. What next? We get the figure for depreciation from the asset register. Reason being, it gives us the ending balance, which is to be depreciated. You mind? Nothing. Depreciation, you don't use anything like Is it asset register or is it what? Okay, the costs are always there. The costs are always given. Okay. Although for you, if you go to the register, cost is you're being more conscious and you want to be sure that what you have in the report indeed is what you're going to report upon. But otherwise, if the opening balance is 100,000, like I said on the question, there's no that figure is going to change. Okay. So I know that you used to go to banking. Okay. In class, they told you that you go to banking. Yeah. Then you check for, what do you check for? You use register. Yeah. Okay. It's a good option. Banking. Then you say use register. Only assets, liabilities, and capital as to QuickBooks are reported instead. Okay. So now, unfortunately, we did not spend any money on assets. So the report can't give us those balances. That's the problem. But otherwise, you'll get the same answers like I've just explained. Until some forget in case the question has some additional information. Okay. It is well. Okay. So guys, that is how we do what? Depreciation and accumulated depreciation. What else did you ask? Okay. Now, assuming you had accrued expenses, they will tell you that you incurred salaries, those are expenses, or electricity. Then they tell you that you have maybe 2 months salary outstanding. Now, once you see that, that is accrued salaries. So just write somewhere, you say accrued expenses. What we do with accrued expenses is that we are going to debit the expense itself. If it is salaries outstanding or accrued salaries, we are going to debit salaries expense, okay, and then credit salary accrued. So how do we do that? So salary accrued is a liability. So you come to your accountant, because like I said, those ones use journals. Come to accountant and make journals. Okay, assuming you're saying salaries. So you come here and you say the journals are clear. If it is accrued expense, we increase the expense by debiting it. So you come and debit expense. It was salary, so come and look for salary. Let's think salary again. Sorry. I'm trying to see the figure. Sorry. Where to see it? Okay, assuming, okay, since it's not here, you can still input it. Okay. So you come, because you can't see that because not there, then I want to put it. No, you put in your account, you say add expenses, then you say continue, and you say salary. Then you say save and close. Okay, how much was it? Maybe the outstanding was 50,000. Okay, then we credit a liability, accrued salaries. So you come and say add a new. Liabilities, you know, they fall under other. So you say other current liabilities. Click on it. And you say continue. Then you say salaries outstanding.
You have never beaten me at
Outstanding or accrued. Or accrued, then you save. So that's what you do, then you save. Okay, guys, that's what you do in case of what? Of an expense outstanding or accrued. For an expense prepaid, it is the reverse. You debit expense prepaid as a current asset, and then you credit the expense itself. Okay. So unless you have any questions, guys, I beg to stop here. Okay. So the same thing applies to incomes also. Incomes, you have them outstanding or prepaid, but for them they're the opposite of assets. I mean of expenses. That an accrued income is actually what? You have incomes accrued or outstanding. It's actually a current asset. Okay, so what we do is you debit accrued income and you credit the income itself. Okay. It's opening balance for drawings. Okay, for drawings is an equity item. Eh? So what we do is we still use journals. Okay, we still use journals. So you come to accountant and make journals. So assuming drawings were in cash, right, that somebody came and withdrew money. Okay, assuming drawings was in cash, what you do is you come to you put the date, of course. Then you say drawings are debited. So you create an account. Like I said, drawings is an equity item. So you come under equity. You say continue. Then you call it drawings. Okay, then you say okay. Then you put the amount, assuming you withdrew 40,000. Well and good. Then what we credit is where the money is coming from. The drawing is coming from inventory or it's coming from cash. Okay, so whatever the case, that's what we do. So it's assuming it is coming from inventory, cash, you come and reduce the cash by adding here. Actually, it's supposed to be there. And then supposed to add. So you look for cash account, which is under assets. Current assets, not there. So let's just assume now that it is withdrawing from inventory assets. Okay, assuming you withdrew an asset, it took inventory items at home for personal use. So that's what you would do. Then save and close. Okay, you debit equity. You debit drawings, but drawings is an equity item. So you go under equity, then you create the drawings account. Then save and close. Okay, what about entering opening balances for given creditors? For creditors, I told you that you go to vendor center. Okay, for creditors, those are suppliers. So you go to vendor center. Okay, vendor center. And you click on it, this is what you will see. So you come here under new, you click this drop down arrow, then you say new vendor. This is what will come. So you put in the balance, the creditor. If it is maybe Musa this time, the opening balance is put there. Okay, whenever they give you individuals, leave alone when they say total creditors or trade creditors or trade payables are 40,000 million. That one is different. You can use journals and you're fine. But where there are individuals with names, this is how you capture it. Musa, put the opening balance that they're demanding, that is demanding. The date as usual, very, very important. Okay, put the amount there. Yeah, then you save and close. That is how we capture vendors' balances. The same thing applies to receivables or debtors. If they're opening balances and they're individuals, just go to customer customer center, then new customer, put the names and the opening balance. Okay, guys, that is it. Okay. All right, guys, thank you for listening to me. For those who want the recording, I don't think I'll be able to upload it tomorrow. I don't think I'll be able to upload it tomorrow. Okay. So otherwise, thanks for attending. I want to say have a good night. Okay. Okay, guys, you're welcome.